Welcome everyone. We'll just wait a minute or so to get started. Hi everyone, we're just waiting for a few people to join and then we'll get started. Thank you. All right, so tēnā koutou everyone. My name's Cath Lomax and I'm the Chief Client Officer here at Fisher Funds. So we're delighted to have you join us this evening for our webinar, which is on challenges, changes and opportunities. So tonight, this evening, we're joined by Ash, our Chief Investment Officer. Hi Ash, Robbie, one of our Senior Portfolio Managers. Hi Robbie, Laura, one of our Senior Wealth Advisors here at Fisher Funds. And I'm delighted to say we're going to start this evening with an update from Bruce McLachlan, our CEO of Fisher Funds. So before we get started, tonight's going to be a short presentation with Robbie, and then we're going to be answering some of your questions. We've already had some come through, which has been fantastic. So a couple of things before we get started. So today is information only, so it doesn't take into account your own financial situation, but we have a fantastic team here at Fisher Funds, award-winning client services and advisors. So please do get in touch with us with any of your queries. Secondly, the webinar is being recorded, so we'll be able to share that at a later date. And lastly, no one can see whether you're participating or not, so it's completely confidential there. So I'm going to start and hand over to Bruce, and he's going to talk to us about the recent purchase of Kiwi Wealth and what that means for Fisher Funds clients to be part of one of New Zealand's largest investment firms. So welcome, Bruce.
Oh, thanks, Cath, and kia ora and good evening, everyone. Hope this is all broadcasting fine. Look, the legacy of Carmel and Hugh Fisher lives on. In 1998, Carmel and Hugh established the business with a real aspiration to create a fantastic New Zealand investment firm. And I'm very pleased to say after 24 years, we're continuing on their vision for the business, which is to really establish this wonderful, iconic New Zealand business. So yes, last week we settled on the acquisition of Kiwi Wealth. And that for us is bringing together two great New Zealand businesses to create a market-leading wealth management business that's majority owned by New Zealanders, but has got real scale. And that's been the key to the process that we've embarked on through the course of 2022 to complete the acquisition. Now, we're not getting bigger for just the sake of getting bigger. In the funds management world, scale is hugely important. It gives you the capacity to invest in the very best talent and the very best technology and the best range of products and services. So that's what we are seeking to achieve in this acquisition. This is not an ego-driven process just to get larger. I'd like to reassure you all too that our ownership is not changing through this process, that our majority shareholder, Toi Foundation, is retaining 2/3 ownership and the other 1/3 with TA Associates. So we honestly believe at Fisher Funds, we've got the very, very best ownership model that's possible. We've got this long-term, stable, intergenerational New Zealand owner who returns profits into the New Zealand community. And similarly, we complement that with a business that brings international world-class best practice expertise. And that's what we need to compete. That's what we need to be massively successful going forward. So we love our ownership model, and that's being retained. Right now, though, I'd like to reassure you all that for you, hopefully nothing immediately changes. The team that looks after your investments today, the team responsible for taking on these very challenging markets and doing the very best for you is still in place, dedicated to looking after your interests. And similarly, the client teams are still there looking after you. Hopefully you see no changes this year, but going into 2023 and 2024, it's certainly our expectation to offer you more, deliver you more products, more services, better technology, better reporting. That's our vision for the future for 2023 and 24. I would just like to finish though that by saying that when you go through acquisitions like this, obviously it can be distracting. I want to give you reassurance that our number one focus in our business is our existing clients. You are what's taken our business to where it is today. You are where our focus is, and we will not allow this acquisition to take our focus on delivering for you. Thank you very much. Thank you for 2022. It's been a massively challenging year for investors. We do appreciate that you have supported us all the way through. We really enjoy trying to do the very best for you. That's our goal. And I'd now like to hand back to Cath, and you can get hopefully the information that you were seeking from tonight's webinar. Thank you. Thank you,
Right.
Cath.
Thank you so much, Bruce. Yeah, very exciting times here ahead. And that was a great update. So thank you. So I'm going to hand over to Robbie, who's going to have a chat to us around what may be in store for 2023. So we're really looking forward to that presentation. Just a reminder, please ask your questions. I can see there's some come through already. Down the very bottom, you'll see the Q&A button. Put in your question and we'll do our best to answer it either now or at a later date. So over to you, Robbie. Welcome.
Thank you, and thanks very much, Cath. And thank you everybody for joining us tonight. It's great to be with you. And I'll just, as Cath mentioned, just take you through a preamble to reflect on the year that's been, give you some thoughts around the outlook to just set the stage and set the scene for the question and answer session that follows. So to kick off with the scene setting, I mean, this has undoubtedly been a difficult year for financial markets. And I think this cartoon on the slide here, which shows the tussle that we've had between bulls and bears during the course of the year, summarizes what has been a volatile journey quite well. Unfortunately, the bear has been on duty more than all of us would like. But you know, every time we seem to have dispensed with one issue or challenge and things have started looking brighter and the bull seems to have taken center stage, the bears have come in and there have been other issues that have reared their heads and we've seen markets sell off again. So if we think back to the start of the year, you know, we kicked off the year with Omicron and COVID looking as if it was finally going to be in the rearview mirror. New Zealand was coming out of a lockdown, as were other countries globally, and we thought that better times were ahead. Russia then went ahead and invaded the Ukraine, and they sparked a humanitarian disaster on top of an energy crunch, which is still plaguing markets today. We've also had, you know, linked to that, we've had a few false starts with the inflation journey. And linked to that, we've seen interest rates increase and then plateau as we looked as if we've got inflation under control, only to see interest rates rise once more. And that's created a huge amount of volatility across multiple asset classes. But that all being said, the key message that we'd like to leave you with tonight is that investors and markets have actually absorbed and dealt with and are in the process of summiting a lot of these major challenges that they've been facing all the way through this year. And markets also tend to be forward-looking, and that's what gives us optimism as we think about 2023 and beyond. Because although this coming year, we are going to see the real effects of these interest rate increases, people's mortgages are going to go up, consumer spending might be crimped quite severely in New Zealand and in other countries that may impact GDP growth. But to a large extent, a lot of this has already been anticipated by equity and bond prices. And apart from that, we have seen notable signs that the world is rewiring and that companies and countries are adapting to this environment. And it's this that gives us hope that although the journey has been rough this year and unenjoyable, as we look forward, the outlook from here is quite a bit better. So if we just do a quick recap of the year, this next chart that we're pulling up now shows just how tough the year has been for a range of different markets across the world. The dark blue bars on this chart shows how far each of these different equity and bond markets have fallen at their worst during the year. And the teal lines show where these markets have got to as of the end of November. And a key thing I'd like to point out is that the difference between those blue and teal bars highlights just how much markets have actually improved off the lows that we've had during the course of this year. If we take the S&P 500 as one example, it was down 25% at its worst. It's recouped about 11% of that since then, as conditions have improved somewhat. And the difference between those blue and teal bars highlights just how critical it's been during this journey to keep your head and not make rash decisions, especially when the world has looked at its bleakest. That could have cost you dearly during 2022. The other thing I'd like to point out on this slide is that unusually in this bout of financial turmoil, we've also had bonds and fixed interest securities sell off quite a lot as well. So on the far right-hand side of this chart, you can see that the bond aggregate index, which is a proxy for fixed interest securities, is down 17% year to date as of a couple of days ago. And at its worst, it had fallen more than 20%. That's really rare to see bonds fall by that magnitude and in conjunction with equities. And in fact, if we go over to the next slide, Morgan Stanley went and looked back at data that went back as far as 1871. And they found that this year has been the worst year over that 150-year time frame for the combination of negative bond and equity returns. So it just shows you how unusual and different this investing environment has been for everyone during the course of the past year. Now, the reasons for this financial turmoil will be well known to you, and they've largely been macro in nature. So rising inflation has been a key reason for this turmoil. And it's been driven by a combination of, a delayed reaction to huge financial stimulus programs that we've had all the way through the COVID era. And that in turn has driven huge demand for goods and services by consumers. Supply, unfortunately, has not kept pace with this demand because of supply chain disruptions as the world economy has emerged from COVID lockdowns. This, as a consequence, has led prices for goods and services and commodities. It's led to a very strong squeeze in those prices, which has fed into the inflationary impulse. And then mixed in with this, obviously, we've had this global energy crisis, which has been exacerbated by the Ukraine war. And together, this has created a cocktail that has led central banks into hiking interest rates at a pace that we have not seen in decades in order to try and dampen demand and stem this inflationary impulse. This has led to a lot of turmoil for multiple asset classes. And most recently, we've seen a spectacular implosion of the cryptocurrency world. Now, it's largely because inflation and rising interest rates have been at the forefront of this turmoil that bonds that I spoke about earlier have been so negatively affected. And this is why bonds and fixed interest securities haven't played their usual role of being shock absorbers and good diversifiers for multi-asset portfolios, and particular conservative and balanced portfolios. But this is where the good news starts, because through the storm, we are starting to see signs of light shining through. So if we think of inflation being the key protagonist in this market volatility, on this slide, you can see on the top part of the slide, the teal part of the slide, you can see how multiple commodities freight rates have increased quite markedly during the course of the year. And so from the start of the year to their peak, we've had oil up 70%, which is a huge move. Wheat up 65%, impacted by the Ukraine war. Copper and freight rates were up 10% at one point, and EU natural gas was up 650%, which is a huge increase in a very short space of time. But if you look at the bottom part, at the red part of this chart, from the peaks, we've also seen most recently all of these prices retrace quite strongly, and that bodes well for economic growth and for markets in the future. So oil is off about 30%, EU natural gas has fallen 50%, as we've seen the EU and Germany in particular reorganize their supply chains with respect to gas, and they've managed to replace a huge amount of Russian gas with LNG imports, which they've done a spectacular job of doing, given the short timeframes that they've had to prepare for this northern winter. We've also seen wheat retrace, 37%, and freight rates have obviously collapsed down 82% as supply chain bottlenecks have been resolved. And this just reflects the human ingenuity and the strong adaptability of companies and countries in surmounting the challenges that we've all faced this year. And it's one of the key reasons, as we speak to the companies that we invest in, that we're becoming more excited from an investing standpoint. So on this next slide here, we show a chart that JP Morgan compiles each year. And JP Morgan are in the 27th year of publishing their Bible on long-term capital market return assumptions. And on this slide, you can see that their current expectations for longer term returns for different asset classes, which is reflected in the teal bars, are quite a bit higher than their expectations a year ago, which is reflected by the blue bars. So for example, with US large cap equities, they think that this confluence of factors that we're facing in markets today, with lower valuations and share prices having come off, the return expectation there has increased to 8% per annum over the next 10 years or so. In contrast, a year ago, they thought the same expectation would deliver a 4% return. So their conclusion when they look across all of these different asset classes is that markets today offer the best long-term return potential in more than a decade. We can understand the sentiment because when we talk to the companies that we invest in, we're seeing quite a bit of evidence of the changes that they're making within their businesses to get through these challenges, and they're starting to bear fruit in some of the companies that we invest in already. So across the investment team, our team is busy finding what we think are pretty good long-term attractive investment opportunities across both the fixed income space and the equity space. It's always tough to know when exactly this is going to pay off and translate into higher portfolio returns. But we think that the groundwork is being laid for that future. And as a consequence, we are much more optimistic as we look out to the future from here than say we were about 10 or 11 months ago. So in summary, it's been a tough journey this year. The destination we find ourselves at is a lot better. And I'd encourage you to reach out to our team, raise questions that you have that relate to these topics. Speak to your advisor and ensure that you're as well positioned as you can be, given your particular circumstances for the investment environment of 2023. So that's a wrap from me, Cath. Back to you for Q&A.
Yeah, fantastic. Thanks, Robbie. And I love the analogy about the light peeking through the storm. That's great. So I've got lots of questions. We had some earlier this week. So I'm going to actually start with you, Ash. So building on Robbie's summary and comments, can you tell us how the investment team is shaping the portfolios to really capture the opportunities in this environment? And so what sort of investments have they been buying and what sort of themes are at play across the portfolios?
Yeah, great. Thanks, Cath, and good evening, everyone. It's great to be here, and it's a good question to start on because it is important that as active managers we are really trying to take advantage of these opportunities to tilt the portfolios and come out the other side stronger. But Robbie's already alluded to a long list of risk factors. He had a picture there with a whole bunch of different things: the crypto meltdown, recession risk, inflation. And the reason that we actually think the opportunities are the best now is because the list is so long. The list of concerns mean that a lot of these concerns are actually priced into equity and fixed income prices. And we're using those sort of price signals to start adjusting our portfolios. Within the, so Robbie showed the JP Morgan chart there, which showed the high level return expectations for different asset classes, but we bottom up investors. So when we look at fixed income securities, for example, Dave, Quinn and their team are trawling the globe looking for fixed income, so bonds and loans to make to companies. And this time last year, we were investing in investment grade credit. So investment grade bonds, high quality companies in the US, we would have got a 3.5% return. The same companies now yield 7 to 8% return. So that is just an example of investment grade. But if you're willing to look at some high yield bonds, there are places where you can get 10% plus yield. So we're starting to gradually rotate these fixed income portfolios out of government bonds, which tend to offer lower yields, into more credit. And it's the same on the equity side too. Our equity portfolio managers have often a long watch list of companies they really admire, but haven't ever been able to buy because the price has been too high. So we've been able to buy some of them this year. So companies like Salesforce.com or Microsoft are great businesses that we think have got really great long-term prospects. They've just always been really expensive. But in a year like this, you often get the baby thrown out with the bathwater and all these really quite attractive opportunities. So I think in times like these, it's really important to think micro. So think about companies and the individual securities rather than thinking too much about the macro. There's always something to worry about inflation. You can try and wait till after the recession before investing. But the reality is if you look at the fundamentals, the underlying companies, we're starting to see some pretty good opportunities out there.
Great, thanks, Ash. But what about our multi-asset portfolios? So how are we positioning these to get the best returns for our clients?
Yeah, no, it's a good question. And just to explain, multi-asset portfolio, that just generally refers to our KiwiSaver funds that have different asset classes. So, equities and bonds and property within them. Now, first, before talking about what we've done to change them, I guess the key thing is those portfolios, particularly the balanced and conservative portfolios, because of the rise in interest rates, the outlook for those portfolios looks a lot more attractive than it does a year ago. And for the reasons that Robbie explained, we had this sort of 1 in 50 year event in bond markets, but the outlook for those portfolios overall, we think, is more attractive. But then we still have options within those portfolios to adjust things. So we have been gradually increasing our equity weight just a little bit as markets are falling, to try and take advantage and buy shares at lower prices. And in the bond universe, as I mentioned earlier, we've been tilting more towards credit instead of government bonds. But importantly, we're looking at structural things that we can do as well. So we've actually, a year ago now, we set up a new international equity fund, which is feeding into those portfolios and has been, really working quite well this year. But also in the last couple of months, we've set up a global credit fund and a private debt fund, where Dave and his team are scouring the globe for new ways to invest money in the bond space. So that's actually throwing up some pretty good opportunities as well. So it's about always trying to add new sort of asset classes and new options into those multi-asset portfolios, so they're well prepared for the future.
Yeah, great. Thanks, Ash. Laura, welcome. I'm going to ask you a few questions. So if returns from assets are starting to look more attractive today, what can clients sensibly do from their side to take advantage of this? And a sort of second question as part of that, and I know this is a question that many of our advisors or clients ask us, is in particular, should a client pay down their mortgage and reduce their debt with surplus income in this environment? Or instead, should they invest in managed funds when the shares are cheaper? So keen to hear your thoughts.
Yeah, well, thanks, Cath. I mean, that's a great question. And like many great questions, there's not necessarily going to be a one-size-fits-all answer. And this is a great scenario to talk through with your advisor if it applies to you. As a general comment though, with interest rates higher than they have been for quite some time, it is a good time to be looking at reducing your debt load where you can. When investing into growth assets, the shorter term return is always a bit uncertain, whereas your interest rate is a bit more of a known liability. But that said, if you've got the ability, it would be a real shame to overcorrect and stop contributing to something like your KiwiSaver, as the long-term growth potential from your contributions today becomes really significant over time. And that longer-term significance is only magnified by today's lower market valuations. So for clients who are still able to contribute even small amounts into the market regularly at these levels, there is real potential for huge growth over a longer term time period.
Great, thank you. Excellent. Robbie, I'm going to go to you, back to you. So I'm interested in your comments about adapting and rewiring being done by companies. To explore that further, can you give us an example from a company in the portfolio that you manage?
Yeah, well, so I manage the Australian equity portfolios, and we've got a company called Ordinate, which invests in it creates hardware as well as software that is used in audio equipment to help audio equipment network with each other, so that microphones can speak to speakers and so on. And they've had a challenge this year in sourcing microchips out of Southeast Asia, like many companies. So they've approached this by literally redesigning a bunch of their chips so that they can source more abundant microchips that there are no shortages of, and put them into their hardware. And then in addition to that, they've invested a lot of time and effort in turning the software, or increasing the flexibility of the software componentry, so that it can be retrofitted into physical products, so that they avoid the necessity of actually putting in microchips at all. So that would be one example. ResMed is another example, where they make ventilators. They're the global leader in supplying people with sleep apnea with ventilators. And again, they've had a microchip component shortage, and they've had a workaround whereby they've gone back to using some of the old technology, the old card technology, where you literally insert these old cards into the ventilators to capture the data that's necessary, and then you can upload that physically into the cloud. It's a short-term workaround solution, but it's one way of making sure that they can treat their patients and meet the demand of their customers while tiding over this period until the microchip shortages are abate.
Great, thank you. Bruce, I'm going to ask you a question actually, so hopefully you can take yourself off mute there. So we've got a question that says, my wife and I are both customers of Fisher Funds and Kiwi Wealth. Will our two joint accounts and portfolios be merged into one eventually, or will they be kept separate?
Well, it's a good question too, isn't it? Look, first of all, I'm really pleased you asked the question. I would expect there'll be no change for the next 12 months, that those accounts will be run separately. And then whatever we do after that point, we would do in consultation with you. So we would come and ask you how you'd like your funds managed on a go-forward basis. So you can be pretty sure we wouldn't make a force of change on you in bringing those together. Thanks.
Thanks, Bruce. Ash, we've got a few questions coming through around RBNZ hiking interest rates and being very, pointed around wanting to engineer a slowdown in New Zealand. Should our clients be selling their investments in the New Zealand equity portfolio, or what should they be thinking about?
Yeah, the point is right that the Reserve Bank is actually really trying to slow down the economy, which seems like perhaps a strange thing to do when central banks have been trying to support economies for a long time. But the reality is they have a mandate to get inflation under control, and hence the really rapid pace of rate hikes we've seen. And that's been really the main driver of the sell-off in global markets this year, is just how rapidly interest rates have gone up. Now, tied to that, Kiwis do have generally a lot of mortgage debt, and a lot of it is on short-term fixed rates. So throughout 2023, we will see consumers come under more pressure, and that's why people are talking about, the risk of recession. The offsetting factor, though, is at the same time, unemployment is extremely low in New Zealand, and the economy seems to be operating pretty resiliently so far, despite the hikes that we've had already. And there's always the factor that if the economy does start to slow and inflation comes down, the central bank can back off. But look, the reality is no one knows the answer on whether we're going to have a recession. But as Robbie alluded to earlier, markets are already pricing like there's going to be some difficult times ahead, and it's always difficult to pick whether you want to sell when there's bad news or and wait till the coast is clear. But you probably remember back to COVID, about a month in, markets were down 30%, and then a couple of weeks later, markets started to rally pretty significantly. There was no good news. It was really bleak. There was no vaccine yet. There was the cases were exploding, but markets started rallying quite quickly, simply because people realized that they had overreacted and prices were getting cheap again. So there's not necessarily a catalyst. Trying to pick what the next economic move is going to be, just how deep the recession will be, is an extremely difficult thing. And finally on, should they sell New Zealand stocks? Well, I think it really depends on the stocks and how resilient you think they are to whatever economic environment we're going to have. In our New Zealand portfolio, actually, a large proportion of the revenue comes from offshore. So a company like Fisher & Paykel Healthcare, it's an international company. It's just got a head office already here in New Zealand. It's the vast majority of its sales come from offshore. Same for Xero, same for A2 Milk, same for Main Freight. So I wouldn't dwell too much on the shape of the economy when you're looking at the New Zealand share market necessarily.
Yeah, thanks. So Laura, with the RBNZ telling markets, that it'll take the cash rate potentially up to 5.5%, is now the time for our clients to think about term deposits or holding more cash? And I know this is a conversation that we've had in some of our Women in Wealth webinars recently.
Yeah, it definitely is. Well, term deposits definitely have their place for investors who've got shorter term investment needs, or have got other factors that mean that they need to be very, very conservative. And these investors are probably quite pleased that term deposit rates are a bit higher than they have been in recent years. However, for many of us, in fact, most of us, term deposits and other cash investments are just not going to optimize our long-term savings growth. In fact, quite the opposite once we take the effects of inflation into consideration. So if you keep a $100 note under the mattress for 10 years, after 10 years, it will still say $100. That's its nominal value, but its real value will likely have decreased. And that is the amount that you can actually purchase with that $100 goes down over time as inflation causes the price of most goods and services to go up over time. And that's very clear to us all in the current environment, especially. So while term deposits do provide a higher return than cash, they're still unlikely to give you much growth over time against inflation. So while the ups and downs are scary, investing in assets like shares has historically been one of the best ways to actually grow your savings ahead of inflation over long-term time periods to actually increase that purchasing power that you need. The trick for most investors is just finding that right mix between those super conservative investments like cash and term deposits and then growth assets like shares. And that's where it can really help to speak to an advisor.
Yeah, and what about some of our clients and some on the webinar today are very close to retirement or have retired. So how should they think differently about their cash, term deposits, or managed funds or KiwiSaver?
Yeah, again, there's just no one size fits all answer. But investors who are just retiring now often still are going to have quite long lives ahead of them. So remember, in investing, anything over about 10 years is considered long-term, and longer-term investing requires growth in order to keep up with inflation. Retirement is a great trigger to review your asset allocation with your advisor and potentially move to a more conservative approach. However, as I mentioned before, it's going to be really difficult to keep up with inflation, keep up that purchasing power without investing in at least some growth assets as part of your overall mix. I also often come across clients quite often who are fortunate enough to have quite a significant nest egg, and they often want to invest with a bit more growth in mind, knowing that they're likely going to be able to pass on most of that to their children and grandchildren.
Thanks.
Yeah, I've got a question I've seen that would be good for Robbie. Looks like an interesting one. So Robbie, the upheaval in the energy markets has created a lot of debate around the role of ESG and climate change within investing. How has this year changed the responsible investing landscape?
Yeah, it certainly has. There's been, I think, quite a lot written about ESG and responsible investing that we wouldn't have seen last year. So I think what this year's upheaval in energy markets has done is it's made responsible investing or firms that subscribe to responsible investing really become more focused and cognizant on the real world problems and challenges with moving from a fossil fuel driven economy to a decarbonized economy. So offshore, it's been notable that there have been a number of large investment houses that have amended their fossil fuel policies in accordance with this, and moving away from just straight exclusion, simplistic exclusion policies and demonizing companies as being either good or bad when it comes to fossil fuel reduction and decarbonization, to being much more involved in engagement and helping companies and working with companies in making sure that they are going to be match fit for a decarbonized world, but acknowledging that in the interim we are reliant on hydrocarbons and to drive the energy complex, and there is a trade-off there that needs to be balanced. So I think it's going to continue to evolve, Laura, but I think some, I guess, positive steps have been taken insofar as engagement's role in ESG is going to continue to increase, and that I think is a good thing.
Yeah, great, thanks. Ash, we've got a couple of questions around property. So firstly, what will make a better investment over the next 20 years, property or shares? I don't know if you're the right person to be asking, but I'll ask you. And then, yeah, we haven't talked about property market much, and particularly around commercial. We've got many more people working from home now, and potentially don't need the massive buildings. So what's your thoughts on that?
Yeah, two really good questions. And the commercial property one is really topical because there's some really interesting stuff happening with some of these big property funds in the US at the moment. But on the residential property side first, what I would say is historically over the long term, both property and shares have performed pretty closely in line over long periods of time. There's been different cycles there though, and that's why it's potentially good to be diversified between both. One reason that properties work particularly well in some locations, like New Zealand, for example, is the ability to leverage it compared to the share market. You don't want to be borrowing money to invest in the share market, but you can borrow money to invest in property, and that's one thing that's enhanced returns there over the long term. But it's very different geography by geography, because the last 20 years too in the US, Ireland, UK, they actually haven't been that great in their property markets. And there were periods there, and there are countries in Europe where property prices are still below where they were 15 years ago. So it really does depend on the characteristics of each market. And in New Zealand, I do think our property is really quite expensive at the moment relative to income. So if I had to guess which one I'd do better over the next 10 years, I'd probably guess shares, but that's but look, people have said that for a long time in New Zealand, and property seems to keep going up. But I'm reasonably positive on both. If people will have a retirement goal and they want their money to outstrip inflation over the long term, they need to be in growth assets, as Laura mentioned. And I think both have their role in a portfolio. On commercial property, yeah, we do see some real challenges for office in some parts of the world. And if you look at some data in New York, vacancies are really quite high, and people just simply haven't come back from lockdowns there. They're still working from home. Retail, perhaps a little bit the same. That was more impacted by e-commerce, but what we're finding there is, malls and retail property, people are gravitating towards, the biggest and best mall in a particular regional area. So we're a little bit cautious on. We do own direct properties in our KiwiSaver funds. So we have commercial property in our KiwiSaver funds. We're really leaning towards industrial at the moment, often warehousing and logistics facilities, which are benefiting from a range of different factors, but one is e-commerce and the need to move parcels around. So we've been tilting that portfolio towards commercial and industrial property recently.
Great, thanks. I've got another question for you straight away. So here we go. And how much is politics affecting fund performance? For example, government spending policies, the increase in wage and fair pay agreements we've seen in places like Australia recently. And I guess that kind of flows on to the next question around both the US and European share markets and economies seem to be at risk at recession for different reasons, and maybe some of the major threats that you see over the next year or so for international performance and how we manage those. Quite a couple of big questions.
Yeah, no, lots of good questions in there. I think my overarching comment on government policy is that it gets a lot of airtime and it causes a lot of concern, but it never has quite the impact in most countries anyway that you would think on the share market. So in most Western democracies, whether it's the US or the UK or potentially New Zealand, there's a lot of gridlock politically. There's a lot of media pressure, and policy doesn't swing around, massively. And there's always a lot of talk, but change tends to be gradual. Where that's different is perhaps somewhere like China, where government changes can be pretty significant and sweeping, and that can have a far larger impact on the share market. So things like Brexit, the US-China trade war. Those are things that got talked, even some of the Trump administration decisions, they got talked about as things that could have a major impact on the share market. But really, after a couple of weeks, once everyone had digested the headlines, they didn't have a major impact. All of that said, that this sort of second part of the question there, I think, was about whether some of the government policies, they're actually spending too much and contributing to the inflation problem. And things like some of the fair pay policies or perhaps some of the cost of living payments that have been made, they do actually risk causing or entrenching the inflation problem. And that's why a lot of commentators have been a bit cautious on that. The reality is the government's in a difficult position. They've got to get inflation under control, but they also have a population that's really struggling with the rising cost of living. So they're trying to balance that up. But I think a lot of these policies generally in isolation, I wouldn't be overly concerned about unless government spending really does get out of control. I think the final part of the question, just on different markets. Look, I'm reasonably constructive on the US. So the US is a large area of investment for us. It's by far the largest part of our KiwiSaver portfolios. And part of the reason for this is if you think back to the housing market example in New Zealand, where half of New Zealanders with mortgages are going to refinance at materially higher rates over the next 12 months. That isn't the case in the US. Most people in the US learned their lesson in the global financial crisis, and they took out, in many instances, 20 or 30-year mortgages at really low fixed rates, so 3-4% rates. So they're not going to have to refinance their mortgage for more than a decade, and that actually gives them a lot of certainty around spending, and their incomes are still increasing, but their mortgage payments are locked in. So I actually think the US is more likely to come out of this more strongly than perhaps even the New Zealand economy.
Okay, thanks, Ash. I'm going to ask you one more because you're on a good flow there. So there've been signs of optimism, which is really good. Does that mean we've seen the lows in the portfolio? And then how long will it take? This is a question our clients ask. How long will it take for our portfolios to get back to the highs that they were?
Do you want it to the nearest week or?
Yes, please, if you don't mind, like before Christmas.
Yeah. No, I think, and Robbie talked about this in his presentation, markets are up sort of 10 to 15% from their lows. So there's definitely some signs of optimism, and that's partly linked to what we've seen in the US in the last few weeks, that inflation has actually started to slow a little bit, which is what everyone's been watching really carefully. But it's really hard to say whether we're, markets go lower or higher from here. But to retest the lows that we saw a couple of months ago, I think the news would have to get quite a bit worse. Would have to see inflation continue to push higher or unemployment to really tick up. But we haven't really seen anything to suggest that would be the case. So if I had to make a base case guess, it would be that markets, gradually climb higher from here. In terms of how long it takes to recover is a really interesting one. We've looked at lots of data on this, and it can take anywhere from 5 months to 5 years. But the reality is that if it's not one of the big ones like the dot-com crash or the Great Depression or the global financial crisis, then on average it's been about a year. And if you think about that, markets are still 20% below. Well, they've still got another 20% to go up to reclaim their previous highs. So over the next year or so, I wouldn't be surprised if we did see those sorts of movements. Yeah, but I think I don't like to make one year forecast, but on a 5-year view from the prices that we see in markets, the opportunities that we see, I think people that are investing both in equities and bonds here will do really well over a 5-year time frame.
Great, thanks. All right, I'll give you a break for a moment and I'll ask you some questions, Laura. So as mentioned earlier, you've been quite instrumental this year in leading some of our communications involving women in finance, and in particular, thinking about what those key messages are for women, which I actually think are for all of our investors. But what are the key messages that you've had for women around investing in managed funds and KiwiSaver? If you could summarize the key points, what would they be?
Okay, yeah, thanks for that question. Yeah, working along with Victoria and Cath as well, and lots of other clever people behind the scenes, I've been really enjoying the work we're doing in this space. But you're right, the messages do apply to all of us, not just to women. That said, as women, we do still have a gender pay gap, as well as on average working less hours over our lifetimes and living for longer than men. We can still improve our retirement outcomes though, with education and some smart planning. And I guess the key message I would have for women is that taking charge of their investing is actually a lot easier than it seems. So I'll keep it to 5 key messages. Here are some simple things that we can all do to improve our retirement savings. Number 1, start a KiwiSaver as early as possible. Get some advice so you're choosing the right strategy, and remember this will need to be reviewed over time. The impact of investing in higher growth strategies over a really long time period can be hugely significant. So you really want to make sure you make the most of this while you can. Number 2, time in the market is much more important than trying to time the market. 3, don't be scared of risk and growth assets. The ups and downs you get investing in shares over short-term time periods smooths out to an attractive return over time. 4, the value of cash goes backwards over time thanks to the effects of inflation. So we need to look beyond cash and term deposits when it comes to building our wealth. And lastly, there are so many different investment options out there to suit people at all different stages of life, all different stages of wealth creation. So when in doubt, just don't be afraid to reach out and get advice so you can find the right fit.
Great, thank you. They're great lessons, ones that I've been imparting on my children. So hopefully they can look after me when I retire. And we've got a question that's just come through about do we charge for advice? And so we don't charge here for advice. So you feel free to pick up the phone or talk to any of us, and there's no charge for advice. Robbie, Ash, I'm going to throw back to you around specific to New Zealand, and particularly around Ryman and retirement village sector over the years. And they've had a particularly tough time of it recently. So maybe just telling us about why the share prices have been down so much and what we've done with those positions in the portfolio.
I'm happy to take that, Robbie, but unless you wanted to jump in.
No, you go for it, Ashton.
Yeah. I've got a few different thoughts on Ryman because it's been a real great New Zealand success story for over 20 years, and we've actually held it since right at the start of Fisher Funds, the New Zealand Growth Fund. And I think at one point about 2 years ago, the investment had increased 100-fold over that period of time. So it's been a phenomenal New Zealand success story, but it's also an interesting investment lesson because you have to remember that some things do well for a long period of time, but it doesn't mean they always will. And it's important to be constantly reviewing your positions. And I'm really pleased that that Sam and Matt, looking after the New Zealand portfolio, really did take the Ryman weight down in our portfolios pretty significantly over the last couple of years, and it's actually a reason to be very small weight at the moment. So gone from this really great success story, this growth story, to a period where they got so large because they were successful that it became harder to grow. So they moved into Australia. They bought quite a bit of land over there, which is a market that's just harder to break into. There's sort of more regulatory issues there. And in New Zealand, to keep building out units, they started building denser units with multi-level rather than just building individual retirement units. And the new ones have a lot of care facilities in there as well. So they became very capital intensive, and they also became you couldn't just build it unit by unit and recycle your capital as you sell each individual retirement unit. So they've got a lot more capital tied up in the business now, and as a result, their debt levels have moved up, and the business has come under quite a bit of pressure. So those are sort of the reasons that we've become a little bit cautious. It is also linked somewhat to the property market, which is another area of concern for us. But look, we think these are just sort of some temporary issues. Probably, we think it's still a lot of growth ahead in the retirement sector. We really still have a positive view on Somerset, but for now, Ryman's at a lower weight for us.
Okay, thanks. I've got quite a few questions coming through, which maybe I'll throw to you, Robbie, which is it's either crypto or gold. Do we, someone says we don't invest in crypto, so they've got that right. But could that impact some of our investments? And then what about gold? Should we have some representation of gold in our portfolios? So kind of two extremes, are they?
Yeah, it's two extremes. Well, one has been sort of touted as the digital gold, so perhaps they're supposedly linked in that respect, albeit the outcomes this year have been markedly different between the two. I'll start with gold because and then touch on the crypto part. Gold, there is a theory that gold should form part of multi-asset portfolios because it is a store of value, and when inflation goes up and or geopolitical uncertainty reigns, gold has historically proven to be a safe haven, and that's been proven out over hundreds of years. The flip side to that, though, if you think about the way we invest in Fisher Funds, is we are bottom-up investors. We seek to find productive assets that generate an income and where we can determine what the intrinsic value of those assets are. And with gold, there's no intrinsic value to gold. It doesn't produce any cash flow. In fact, you've got to pay money to store gold. And so when interest rates are low, that storage cost is quite low. But as interest rates have risen this year, that storage cost has actually gone up. So interestingly, gold, although it should do really, really well in an inflationary environment, this year it's actually down a few percent, partly because the cost of owning and storing gold is going up relative to other assets. And then linked to that is if we just try and compare productive assets to unproductive assets, from our perspective, we think over the long run, if you can find a blend of a mix and blend of productive assets with proper pricing power, to the question to the comment made earlier that shares are a better way of protecting yourself against inflation than storing cash under the mattress. But we probably think the same way about gold. Cryptocurrencies, we are not invested in cryptocurrencies. We don't have any and never have had any crypto currency or crypto exposure in any of our portfolios. I think relative to given what's happened over the last few years, that is largely an experiment, and it's not one that's worked out really well. So we'll have to watch how that evolves. But that's not one for Fisher Funds portfolios at this point. The second part of that question, though, was, are there any other investments that may be impacted by the meltdown in crypto? Well, there's always the risk that the financial markets or financial financial parts of the market could have some contagion spread into that if the crypto markets unwind, because there's a lot of capital tied up there. To date, that looks relatively contained. But in terms of specific investments, we do have in our international portfolio, we have one bank that has been lending to, in that portfolio, that has lent to the blockchain companies involved in blockchain and in the crypto world. Ash, you know that company quite well, so I'll hand it over to you to perhaps pass some comments on Signature Bank. It seems to have come through pretty well thus far.
Yeah, thanks, Robbie. Yeah, so Signature Bank does have a small part of its business which basically takes deposits from some of the crypto exchanges, but it is a very small part of its business. It doesn't do any lending or anything like that in that particular space. It really is just a service provider to some of those businesses. And given it was a new market, what they have done is essentially ring fence the deposits they've got from that, so that if they decide to, they can actually wind that part of the business down without having too much of an impact. So, but overall, that will be the only company that has any exposure to crypto in our portfolios, and even then, it's quite a small part of that particular business.
Right.
Cath, can I jump in there? A question that's just popped up in the chat, which relates to the Australian equity portfolios, is that the ASX has recovered from where it was 12 months ago, yet the Australian Growth Fund is still down about 9%, and it doesn't pay a dividend. So can you just comment on this? So if we can just touch on that just for a minute or so. That's true. The Australian the Australian equity market has been a very strong outperformer globally, and it has largely recovered from its losses earlier in the year. That's been driven by a very strong skew towards materials, mining companies, commodities, as well as energy, which makes up a big part of the index in Australia. Now, relative to that, within the Australian growth portfolio, we are very much focused on finding companies that are high quality and have got good structural growth tailwinds behind them, companies that are in control of their destiny, have really good positions, market positions from a competitive standpoint, and can drive their earnings growth under their own steam. And so with that backdrop, commodity companies involved in commodities typically don't fit our investment process that well, primarily because they're not in charge of their own destiny. So yes, the likes of these commodity producers have had their day in the sun this year, but over a long period of time that we've been investing and running with with our defined quality and growth investment philosophy, we found that focusing on businesses that really dominate their space and control their destiny has proven out to be, over the long run, a better place to be for our portfolios. And so yes, it's been a better year for those commodity producers, but I think over the long run, our tried and tested investment strategy should play out. And then in terms of dividends, the Australian Growth Fund, along with all our other growth funds, they're not distribution or income funds, so that none of them pay dividends.
Thanks, Robbie. Right, I've got one more question here for you, Ash, which is, in this volatile environment where individual company fortunes are changing quite markedly, isn't active investing just too hard and risky? And should investors just invest passively in the index and be done with it? So you can finish the session off for us, Ash.
Right. Well, I'd almost say, the complete opposite, sort of to the contrary. If there's one time you really want to be an active investor, it's when markets are really volatile. And it is interesting, what you notice in sell-offs like this is everything gets sold off together. There's no differentiation. Everything's down significantly, but some of the businesses should be down significantly. Some businesses that really didn't need to exist, didn't make a profit, and only ever listed on the share market in the last couple of years because markets were really bubbly. But then there are other great businesses that have sold off. Amazon was down 50% at one point this year, despite having a phenomenal e-commerce and cloud computing business, and we think years of growth ahead. And what we've also found through time, through various Fisher funds, whether it was back in the early 2000s coming out of recession, the New Zealand Growth Fund, whether it was coming out of the global financial crisis or out of the COVID crisis, most of our portfolios have outperformed the market on the way back up. And that's because of the work that we do at the bottom, really readjusting those portfolios and repositioning them, high grading them into portfolio companies that we think will do really well coming out the other side of a downturn. So we're actually really excited by the opportunities, both in the equity space and the fixed income space as well. It feels really uncomfortable for investors at the moment, but often that's when the pickings are the best. Yeah,
thank you so much. Well, thanks so much to all of you for joining us this evening, and a big thank you to Bruce, Ash, Robbie and Laura for answering those questions. If we haven't got to your question, please, we will get in touch, or feel free to contact us, and we will be sending out the webinar. And I thought I would just close with one of our clients sent our advisor, Tom, this message, and I thought this is a very good way to end it. So we wish you, all our clients and your loved ones, a Christmas 2023 and beyond that are filled with peace, rest, refreshment, laughter and hope. So thank you very much, everyone, and a very good evening.